You know, it's kind of wild how our gut feelings can really mess with our heads, especially when we're trying to be logical, like trading in the markets.
Oh, definitely.
Ever heard that the fear of missing out FOMO can actually push people to take crazy risks with their money?
Yeah, absolutely. It's a powerful driver.
It just shows you that making smart trades isn't just about the math, right? You really need a solid plan to keep those impulses in check. And, well, that's exactly what we're digging into today.
That's right. We're going to explore a really effective way to understand what's moving markets and, make more informed trading decisions.
Okay.
Think of it as having a well-organized toolbox built by bringing together three pretty powerful ways to look at market data.
And our guidebook for this exploration is Candlesticks, Fibonacci, and chart pattern trading tools. Now, this isn't just about admiring pretty graphs. The book really lays out a clear strategy for using these three candlesticks, Fibonacci analysis, and chart patterns, using them together, actually, to aim for better profits while keeping potential losses in check. The information you shared really gets into how these pieces fit together.
Absolutely.
Yeah.
And for you, the learner, our goal today is really to extract the essential ideas from this book. We want to give you a clear, structured overview of these techniques, pointing out those aha moments and practical insights that can help you make sense of it all.
So our mission is pretty straightforward. We're taking the core principles of combining candlesticks, Fibonacci, and chart patterns, just like the book presents them. We're focusing on how you can actually use this information and what the most important things are to remember. Okay, let's get into it.
Great. So the book kicks off with a really crucial foundation in Chapter 1, understanding what makes traders tick, trading psychology and investor behavior.
Right.
What's fascinating right away is the emphasis on the human element as like the real engine behind market ups and downs.
Exactly. It's so easy to get lost in the charts and the numbers, but the book really pushes you to look at the emotions driving those numbers. There were some key guidelines for investors in that first chapter that really stood out to me. The first one is simple but powerful. Know yourself. It's all about being honest about how much risk you can actually stomach.
Yeah,
If watching prices jump around makes you super anxious, you might be trading the wrong things. Or maybe your position sizes are just too big for your comfort zone.
that's such a critical starting point.
Oh, yeah.
Matching your trading ideas and the financial instruments you choose with your personal comfort level is just fundamental.
Right.
The book also strongly advises you to put your ego aside. This is so important because we often see traders, especially after a few wins, start to believe they kind of can't lose.
Oh, yeah. Been there, maybe. The book cautions that those first big wins can lead to even bigger losses if they weren't based on a solid plan.
Exactly.
It makes the point that making money without a tested strategy is actually, well, risky in itself.
It really is.
And then there's this blunt truth. Hoping and praying do not guarantee success.
Huh. No, they don't. This really highlights the need for a systematic approach. The book recommends setting a stop loss, an automatic exit if the trade goes against you for every single trade,
Every trade.
and having a profit target in mind right from the beginning.
Yeah.
It's about taking profits when they're there and cutting losses according to your predefined rules.
And speaking of losses, there's a really crucial one. Never double your losses. The book is quite firm on this, explaining that almost every major bankruptcy in trading history happened because people kept adding to their losing positions, just hoping for a lucky break.
Oof, yeah, that's a stark reminder to resist that urge to average down on losing trades.
Definitely.
Then we have know your pain level. This is all about not letting short-term market swings make you just abandon your strategy.
Right. Don't chase the hot dog.
Exactly.
Yeah.
Jumping from one approach to another just because one particular asset seems to have shifted direction is usually a bad idea.
It's about sticking with what you've tested and what you actually understand, which leads perfectly to the importance of a trading plan. The book emphasizes that true success isn't about getting rich quick. It's about steady, consistent growth. Building wealth over time, no matter what the market is doing, requires a dependable strategy and resisting that temptation of greed.
Consistency over speed, that's the mantra. The book also underscores the value of feeling comfortable with your trading strategy.
Okay.
Successful traders, they start their day with a plan they can confidently follow, regardless of market surprises. As long as your actual trading results are, generally in line with what your past testing showed, you can have that confidence.
Lot.
But if your biggest losses start exceeding what your historical tests predicted, well, that's a signal to take a step back and reevaluate.
Makes sense. And the final guideline in this initial section is so clear. Nothing is more important than discipline. It really ties everything together, doesn't it?
It really does.
Successful trading means creating a risk profile that fits you, developing a systematic way of trading that matches that profile, and then just following that system consistently, sometimes for months or even years, until your real-world results confirm your approach.
Exactly. It's about trusting your system and having the discipline to stick with it, even when the market's mood or, frankly, your own emotions might be telling you to do something different.
Okay.
Now let's shift our focus a bit. Chapter 2 introduces what the authors call the magic figure 3.
Ah, yes.
What's interesting here is the idea that these three seemingly different trading tools, Fibonacci, candlesticks, and chart patterns, actually share this underlying theme.
Yeah, the figure 3 is presented as a kind of like unifying idea. The book even includes figure 2.1 just to sort of show how this number pops up in the context of these different ways of looking at the market.
It's a subtle but intriguing point, maybe hinting at a deeper connection between these methods. Then, Chapter 3 dives into the basic principles of trading strategies, focusing on the core ideas behind Fibonacci analysis, candlestick analysis, and chart pattern analysis, and also looking at trend lines and trend channels. Let's start with Fibonacci.
Okay, so Fibonacci analysis. It gets its name from Leonardo of Pisa, also known as Fibonacci, an Italian merchant and a really bright mathematician from way back in the day, like the 13th century.
Right.
He came up with the Fibonacci summation series, 1, 1, 2, 3, 5, 8, 13, 21, and so on. The pattern is just that each number is the sum of the two numbers right before it.
Simple yet profound. What's remarkable is that as this sequence goes on, if you divide any number by the one before it, you get closer and closer to a specific irrational number, roughly 1.618. This is the Fibonacci ratio, often referred to as PHI, or sometimes called the golden ratio.
Sure, the golden ratio.
Conversely, if you divide any number by the number that comes after it in the sequence, you get closer to about 0.618, which they call PHI prime.
And these aren't just like abstract math concepts, are they? The book points out that this 1.618 ratio has been called the divine proportion and the golden section throughout history, suggesting it has some kind of special significance.
Yeah, even Johannes Kepler, the famous astronomer, thought it was a real jewel in geometry.
Wow.
Precisely. And it's not just mathematically interesting. The book explores how this Fibonacci sequence seems to pop up all over the natural world,
That part was surprising.
highlighting how often these numbers and the golden ratio appear in different forms.
Yeah, they talk about how plant stems grow their branches and leaves, and the number of petals on flowers, things like the sneezewort flower, irises with their 3 petals, primroses with 5, all the way up to daisies that can have 34, and Michaelmas daisies with 55 or even 89 petals.
It makes you wonder, doesn't it? Is it just coincidence?
Right.
It really
yeah.
does make you think. The book also mentions how the Fibonacci sequence can be seen in the number of rabbit pairs over successive months, following that same pattern. And then there's the geometry of it all.
Yes, the golden rectangle, where the ratio of the longer side to the shorter side is roughly that 1.618.
Exactly.
The book mentions that even Euclid, the ancient Greek mathematician, wrote about this golden section. And it's not just theoretical. The Parthenon Temple in Athens is given as an example of how its proportions fit nicely within a golden rectangle.
It suggests that perhaps there's a fundamental human sense of what looks aesthetically pleasing, maybe even at a subconscious level, that's somehow tied to these proportions.
Huh. Interesting thought.
Now, when we bring this into the world of trading, the book introduces some basic Fibonacci trading tools, like corrections, extensions, and PHI ellipses. Let's start by looking at corrections.
Okay, so corrections. They're basically price movements that go against the main trend in the market. The idea is that after a strong price move in one direction, what they call an impulse wave, up or down, there's usually a smaller move in the opposite direction, a corrective wave, before the main trend continues. So trading with corrections is a way of trying to follow the overall trend, betting that after the market takes a breather, the correction, it will go back in the direction it was originally heading.
Exactly. The book points out that in these scenarios, we generally expect to see at least a 3-swing price movement. The most common way to analyze these corrections is to see how large they are compared to the previous impulse wave.
Right.
And this is where Fibonacci comes in Certain percentages derived from that golden ratio become really important.
Right. They mentioned 38.2%, 50.0%, and 61.8% as common levels where the market might retrace or correct before continuing its original move.
Mm,
And these percentages are all directly related to those 0.618 and 1.618 ratios we just talked about.
exactly. Now let's move on to Fibonacci extensions. These often happen in what's considered the third wave of a three-wave price pattern.
Okay.
With extensions, the idea is often to trade against the main trend for a short period, aiming to grab quick profits.
Ugh, counter trend. The book highlights that in an uptrend extension, the price usually doesn't fall below the low point of the very first wave in that pattern. And it really emphasizes that if you're trading extensions, you need very clear rules for when you're going to get in and when you're going to get out right from the start.
Absolutely critical. Figure 3.7 in the book shows an example of an extension in the third wave, and the target price is often estimated by taking the size of the first wave and multiplying it by that PHI ratio, 1.618.
Got it. But market movements often involve more than just three waves, right?
That's true. That's where the five-wave pattern comes into play. In a typical five-wave uptrend, the book explains that you can calculate a potential target price for the end of the fifth wave in a couple of ways.
Okay.
First, by taking the size of the very first wave and multiplying it by 1.618. And second, by taking the price difference from the low point of the first wave to the high point of the third wave, and then multiplying that by 0.618.
Okay, two calculations.
Yeah.
And for a downtrend.
Similar logic used the initial price swing and the difference between the high of wave 1 and the low of wave 3. Doing both calculations gives traders a potential area or a band where the price might end up.
Okay, a target zone.
Exactly. Now, the book also introduces PHI ellipses as another tool in the Fibonacci toolbox for traders.
PHI ellipses.
Right.
Right. These are geometric shapes you can draw on charts to help identify possible turning points in the market.
That's the idea. The book mentions that if you see three smaller PHI ellipses kind of nested inside a larger one, it can often be a sign that an important reversal in the price trend might be coming.
Interesting.
What's cool is that you can use PHI ellipses on different time frames, whether you're looking at monthly charts for long-term trends or, intraday charts for short-term trading.
Versatile?
Yeah. The authors mention that while they're introducing the basic idea now, they'll explore how to use PHI ellipses with intraday data in more detail later in the book.
Okay.
So that gives us an initial understanding of some key Fibonacci tools. Now, let's move on to candlestick analysis.
Right, candlesticks. This gives us a different way to visualize what's happening with prices. Instead of just focusing on single closing prices like some other charts do, candlesticks show you the relationship between the opening and closing prices during a specific period.
Exactly. Each candlestick has a body, which represents the price range between the open and the close. And then these lines extending above and below the body called shadows or wicks that show the highest and lowest prices reached during that period.
And the color tells you if it closed higher or lower than the open, right? Like white-green for up, black-red for down.
Precisely. Figure 3.124 in the book breaks down all these parts clearly.
Yeah, and the book even shows a side-by-side comparison, figure 3.13, a bar chart and a candlestick chart using the same price data. You can see how the same info looks different visually but tells the same story.
Right. Now, the book goes into specific candlestick patterns that can suggest either that a trend is maybe losing steam or that it might be about to reverse direction altogether.
Okay, pattern recognition time.
One of the first patterns they discuss is the hammer and the hanging man. These are single candlestick patterns. They have a long lower shadow and a small body that's near the top of the trading range for that period.
Okay.
A hammer appearing at the end of a downtrend is often seen as a bullish reversal signal, suggesting the price might start to go up.
Hammering out a bottom.
Kinda, yeah. On the other hand, a hanging man appearing during an uptrend can be a bearish signal, suggesting the price might start to fall. Ideally, that lower shadow should be quite long, maybe 3 times the length of the body, indicating a sharp drop in price that was then followed by a significant recovery within that same session.
Got it. Then there's the bullish and bearish belt hold. These are also single candlestick patterns, right? Long body, not much shadow on one side.
Exactly. A bullish belt hold is usually a long white candle, suggests potential upward movement, especially if the price opens higher the next day. Conversely, a bearish belt hold is a long black candle, can signal further downward movement, particularly if the price opens lower the following day.
Okay. Moving on to patterns with two candlesticks. The bullish and bearish engulfing pattern.
Yes. Here, the second candlestick completely covers, or engulfs, the body of the first one.
So it's bigger.
Right. A bullish engulfing pattern happens at the end of a downtrend when a white candle completely surrounds a prior black candle. This is considered a pretty strong sign that the trend might be turning upward.
And bearish is the opposite. Black engulfs white at the end of an uptrend.
Exactly. Suggests a potential downward reversal.
The book also covers the piercing pattern and the dark cloud cover. Also, 2 candlestick patterns indicating reversals.
That's right. A piercing pattern, which is bullish, typically shows up after a downtrend. It involves a second white candlestick that opens lower than the previous day's close, but then closes more than halfway up the body of the earlier black candlestick.
Okay, piercing into the prior candle's territory.
A dark cloud cover, which is bearish, happens after an uptrend. Here, the second black candlestick opens higher than the previous day's close, but then closes more than halfway down the body of the earlier white candlestick.
Got it. And we shouldn't forget the Harami pattern and the Harami cross.
Right. These are 2 candlestick patterns where the second candlestick has a much smaller body that fits entirely within the body of the first larger candlestick.
Kind of the opposite of engulfing, like an inside day on a bar chart.
Exactly. A Harami can be a bullish signal if it appears after a downtrend, or bearish if it appears after an uptrend. The signal is often seen as stronger if the second candle's body is very small.
And the Harami cross.
That's similar. The second candlestick is a doji, where the opening and closing prices are very close, so it looks like a cross or a plus sign.
Okay. Finally, in this section, we have the morning star and evening star. These are 3 candlestick patterns suggesting potential reversals.
Yes. A morning star, which is a bullish pattern, usually appears after a downtrend. It consists of a large down candle, followed by a small-bodied candle, the star, that gaps away from the first candle.
A gap.
And then a large up candle that closes significantly into the body of the first one. An evening star, which is bearish, appears after an uptrend and is the opposite. A large up candle, then a small-bodied star that gaps away, and finally a large down candle.
And if the star is a doji,
then it's called the doji star.
Oh,
and
no.
that can be an even stronger warning sign of a potential trend change.
Okay, so candlestick analysis gives us this really visual way to understand short-term shifts in market sentiment, focusing on that open-close relationship.
Exactly. Now let's move on to our third tool in the kit, chart pattern analysis.
All right. Chart pattern analysis is presented as another way to figure out when a market trend might be coming to an end. The book emphasizes that even though computer-based technical indicators are super popular now, being able to recognize these patterns visually on a chart is still really valuable because they reflect, well, the collective behavior of investors.
That's the key point. The book points out that the chart patterns they've chosen to focus on have a pretty strong track record and can be really useful when you combine them with the other tools we're talking about.
Okay.
They then dive into selected reversal chart patterns, highlighting some common things to look for, like how they tend to form at the end of existing trends,
Makes sense.
how larger patterns often lead to bigger reversals in price, and how price peaks in the market generally tend to happen faster and be more volatile than price bottoms.
Interesting observation about tops versus bottoms. Okay, first up are double tops and double bottoms, those classic M and W shapes you often see.
Right. A double top forms after an uptrend, shows 2 roughly equal high points with a dip in between. The pattern is usually considered confirmed when the price then drops below that low point in the middle.
Breaks the valley.
Exactly. A double bottom is the opposite, forms after a downtrend with 2 roughly equal low points and a rise in between, and it's confirmed when the price then breaks above that high point in the middle, breaks the peak.
Got it. M's and W's. Then we have triple tops and triple bottoms, similar idea, but 3 peaks or valleys.
Precisely. A triple top is confirmed when the price falls below the low point that preceded the third peak. And interestingly, if the price briefly goes above that third peak and then falls back down.
Like a fake breakout.
Yeah, a false breakout. That can be a very strong signal that a reversal is indeed happening. A triple bottom is confirmed by the price breaking above the high point that preceded the third valley.
Okay. The head and shoulder formation is presented as a particularly reliable indicator that a trend might be changing direction.
It often is. In an uptrend that's about to reverse, it looks like 3 peaks.
Ah.
The middle peak, the head, is the highest, and the 2 outer peaks, the shoulders, are roughly the same height and lower than the head. The neckline is drawn by connecting the 2 low points in between these peaks, and the pattern is confirmed when the price drops below this neckline.
And there's an inverted version for downtrends signaling an upside reversal.
Yes, an inverted head and shoulders. Looks like the opposite.
The book also mentions 3 falling peaks and 3 rising valleys as other reversal patterns to watch for.
Just briefly. After covering these, it moves on to selected continuation chart patterns. As the name suggests, these patterns often indicate that the current trend in the market is likely to continue.
Okay, so not necessarily a reversal.
Right, although the book notes that sometimes they can act as reversal patterns too. It's not always black and white.
Got it. These continuation patterns include triangles, symmetrical, ascending, and descending.
Yes, these are characterized by trend lines that are getting closer and closer together, forming a triangle shape. A breakout of the price above or below the triangle pattern typically signals that the previous trend is resuming.
Okay. Then there are bullish and bearish rectangles. That's when the price trades sideways between horizontal support and resistance lines.
Exactly, creating a rectangle shape on the chart. A breakout from a rectangle can signal that the trend is continuing, but if it happens after the price has been trading sideways for a long time, it can also sometimes signal a reversal, acting similarly to a triple top or bottom.
Okay, context matters. The broadening formation is noted as trickier to trade.
Yeah, because it involves support and resistance lines that are moving further apart, expanding. The book advises that it's generally safer to wait for at least 3 peaks and 2 valleys, or vice versa, to form before considering a trade based on this pattern.
Exercise caution there. And finally, it briefly mentions spring and uptrust formations typically seen within trading ranges.
Right. The book emphasizes that most of these chart patterns, whether reversal or continuation, are made up of at least 5 price swings, like 3 peaks and 2 valleys, or the other way around.
Okay, 5 swings.
But the main exception being the key reversal day pattern, which is just a single-day event.
Which brings us to the topic of trend lines and trend channels. These are another fundamental way to analyze trends, reflecting that investor behavior, creating peaks and valleys.
Basic trend lines are just drawn by connecting a series of high points in a downtrend or a series of low points in an uptrend. Simple but effective.
And trend channels build on that, need 3 points.
Right, at least 3 significant price points, either 2 peaks and 1 valley or 2 valleys and 1 peak. You draw a trend line connecting 2 of these points, say the 2 valleys, in an uptrend.
Okay.
And then you draw a parallel line through the peak in between them to create the channel. The book explains how if the price breaks above an initial peak, that can confirm an uptrend, allowing you to then maybe estimate where a future peak might occur by drawing that parallel line.
Projecting forward.
Exactly. And if the price breaks out beyond the upper or lower line of an established trend channel, it can sometimes signal the start of a new, even steeper trend channel.
Okay. The book also briefly mentions wedge formations as another type of trendline pattern.
Yes, just to mention. So that gives us a good overview of the basic principles behind these 3 really powerful ways to analyze the market. Now, Chapter 4 dives into how you can actually put these ideas into practice.
All right. Chapter 4, Applications. It starts by taking a closer look at double tops and double bottoms. Reminds us they're common reversal patterns, the M and W, and stresses how important they are in relation to Fibonacci price corrections. The key thing for a double top or bottom to be considered complete is when the price breaks below the valley between the tops or above the peak between the bottoms, and the book emphasizes this should happen on a daily closing basis.
Right, the close matters. The book also addresses the difficulty of spotting double tops, where the second top might actually go a little bit higher than the first.
The bull trap.
Exactly, potentially fooling traders. It suggests being a bit flexible with this and points out you can still have a profitable trade even if the second top is slightly higher, as long as the expected price swing plays out.
Okay. But the most critical factor for success with these patterns, according to the book, is the swing size you choose to use in your analysis.
Absolutely crucial. If you use swing sizes that are too small, you might end up with way too many trades, and the transaction costs can just eat up your profits.
Death by 1,000 cuts.
Pretty much. On the other hand, if you increase the swing size you're looking at, you'll have fewer trades, and the book suggests this can actually improve your chances of making profitable trades.
Fewer are better.
That seems to be the idea. The book recommends aiming for somewhere around 5 to 10 trades per year in a market like the S&P 500 Futures Index as a rough guideline.
Okay.
It also points out that the right swing size really depends on how volatile a particular asset is, and you can figure this out by using computer simulations to look at several years of historical price data.
Do your homework. The book then lays out some typical entry rules for trading these, usually involving entering after the price breaks that key turning point in the middle, and discusses stop-loss rules, where to set your exit to limit losses often just beyond the previous peak or valley.
Standard risk management. The book notes that these strategies tend to work best with products that have high price volatility, and it's important to diversify your trading across different assets to help manage overall portfolio risk.
Right.
The chapter sums up by saying these patterns are relatively easy to spot and trade, they can be used on any type of financial product, and that using larger swing sizes generally leads to a better profit-loss ratio, with the most volatile products offering the most profit potential.
Okay, good summary. Next up in Chapter 4, Fibonacci price corrections and how to use them in trading strategies. The book says this can be really effective when combined with those key Fibonacci numbers and ratios.
Mhm. The crucial thing here, again, is having clear rules. Stop loss, profit target, and entry criteria. The profitability hinges on making sure your potential profit is bigger than your potential loss, and that you win more trades than you lose on average.
Simple math, hard to execute sometimes.
Very true. The book emphasizes that you can actually program these kinds of strategies into a computer and test them out on historical data.
Back testing.
Exactly.
Yeah.
It describes trading corrections as a way to follow the trend, but focusing on shorter-term trades, aiming for a larger number of smaller profits, while always being aware of those potential false breakouts, the bull or bear traps.
Right. When it comes to how big of a correction to look for, the analysis often focuses on that 61.8% retracement level. Comes from the golden ratio again.
That's a key one. The swing size is also really important here, and it can vary depending on the specific asset and the time frame you're looking at.
Yeah.
The book points out that if the daily price movements of an asset are typically tiny, then even a 61.8% correction might be too small to make a worthwhile trade after costs.
Practical point. Entry rules often involve waiting for some kind of confirmation that the trend is resuming after the pullback to 61.8%, like breaking the previous day's high or low.
Exactly, waiting for confirmation. The stop loss is usually placed just beyond the most recent peak, if you're short, or valley, if you're long, that occurred before you entered the trade.
Okay. The book cautions that while tighter stops limit risk per trade, there's also a chance the price might not quite hit your 61.8% level before moving on, so you could miss the whole opportunity.
It's a trade-off.
Yeah.
It's also important to see a high trading volume, along with a suitable swing size, to avoid issues like price slippage and ensure you get filled at the prices you expect.
Right, liquidity matters. Figuring out the right swing size and correction level often involves looking back at 3 years of daily data for the asset and trying to identify maybe 15 to 20 significant swings per year.
That's the suggested process, yeah. The chapter also talks about the challenge of knowing what the main trend actually is.
The million-dollar question sometimes.
Yeah. The strategy generally involves looking to sell when the price corrects by 61.8% during what you believe is a downtrend, hoping for new lows, and buying when it corrects that amount in what you think is an uptrend, hoping for new highs. But of course, you don't always know for sure which way it's ultimately headed.
Right.
The book suggests that if you see a strong initial price move followed by a significant correction, the next price move in the original direction is often even bigger.
Interesting.
It gives some examples and even mentions a CD-ROM that used to come with the book with sample data for replicating test results on the S&P 500 in Japanese yen.
Old school.
Yeah, but it does warn against getting too excited about results from limited time frames, as they might just happen to favor that particular strategy during that period.
Good caveat.
It also includes a more detailed example using the DJ Eurostoxx 50 index over a year, showing how the strategy might perform in different market conditions, and concludes that trading corrections based on Fibonacci levels can be a systematic approach, programmable for diversification.
Okay. Moving on to Fibonacci price extensions. The book describes these as significant price moves in fast-moving markets, often triggered by unexpected news.
Yeah, think volatility spikes.
Okay.
It distinguishes between patterns that have 3 waves and those that have 5 waves.
Okay.
For 3-wave patterns, extensions typically occur in that 3rd wave. In an uptrend, the price correction shouldn't fall below the low point of the first wave unless it's a trap. Trading these extensions is essentially betting against the main trend for a quick profit.
Counter trend again.
So you really need strict entry and exit rules. The target price is often calculated by taking the size of the first wave and multiplying it by that Fibonacci ratio of 1.618.
Got it. And for 5-wave patterns, related to Elliott wave theory, but maybe more waves sometimes.
Right, sometimes more than 5 in strong trends, but usually you focus on 5 for the calculation. The way you figure out a potential target price involves 2 steps. First, multiply the price difference of the very first wave by 1.618. And then you also multiply the price difference from the low point of wave 1 to the high point of wave 3 by 0.618.
Ah, okay, two calcs again. And similar logic for downtrends using the high of 1 and low of 3.
Exactly. By doing both, you get that range of potential target prices, the Fibonacci price target band.
That target zone idea again?
Precisely. The book gives an example using the Japanese yen, showing how a narrow target band can be a really good indication of where the price might be headed.
Okay. Next, the chapter delves into how to use candlestick chart patterns in trading. The book emphasizes they give you a visual sense of trend acceleration, slowdown, or potential reversals.
And they use the same basic open, high, low, close data as bar charts. Interestingly, what might look like a key reversal day on a bar chart could appear as a hammer or a doji on a candlestick chart.
Ah, different visual, same underlying event.
Exactly. Candlesticks are seen as a good way to understand the emotions of everyday investors. The book focuses on patterns that show up relatively frequently and work well when combined with Fibonacci tools representing about 80% of the useful patterns you might encounter.
Practical focus. The book then gives specific trading signals based on several patterns. For a hammer,
The idea is to buy the next day if the price goes above the high of the hammer candle. Set your stop loss just below the low of the hammer.
okay, bullish engulfing.
Look to buy if the price goes above the high of that large white engulfing candle. Place your stop loss below the lowest low of the two-candle pattern.
And bearish engulfing is the opposite sell below the low of the black candle, stop above the high.
Correct. For a Harami pattern, the signal to buy or sell depends on the color of the small inner candle. Buy above the high or sell below the low of the big candle.
Got it. Morningstar.
Look to buy if the price goes above the high of the final white candle, with a stop loss at the low of the middle small-bodied star candle.
And evening star, sell below the low of the final black candle, stop at the high of the middle star.
That's the setup. The book includes an example on a DAX 30 chart showing how these signals might play out with various buy-sell signals. It also mentions some testing done by Rogalski, trading on selected patterns for the DAX 30 and Eurobond future, looking at one-day versus three-day exits. The results were kind of mixed, suggesting that relying solely on candlesticks might not be consistently profitable enough. However, some patterns like bullish engulfing, hammer, and hanging man showed potential on the DAX, and holding for 3 days was often more profitable than just one.
Interesting. Performance seems similar to S&P 500 and U.S. Treasuries.
Yeah, relatable. The book also refers to an article by Mayani suggesting these patterns become more reliable when used with other indicators.
Ah, confirmation.
Exactly. And the authors themselves emphasize the benefit of combining candlestick formations with Fibonacci tools and those three-point chart patterns, which they explore more in the final chapter.
Okay, synergy is key. The chapter then moves on to three-point chart patterns for trend reversals, focusing on identifying when a trend might end and reverse.
Right. It emphasizes looking for patterns with at least 3 peaks or 3 valleys on one side of the chart. This helps reduce the number of potential trades and makes patterns easier to spot.
Filter the noise?
The book notes this approach is somewhat similar to Elliott wave theory, which often looks for 5 waves before a change in direction.
Okay. It recommends Bulkowski's work for more depth on chart patterns.
Yes, a good resource apparently. It divides patterns into reversal and continuation, but acknowledges the lines can blur sometimes.
Right. It then lays out rules for profit targets using ratios, parallel lines, impulse wave size, or just aiming for double the pattern height.
Several methods, yeah. It also talks about trailing stops, moving your stop as the price moves favorably. Suggests using a 3-4 day high-low for short-term, or more significant previous peaks valleys for longer-term trend following.
Makes sense. The book provides examples for patterns like triple tops bottoms, rare but profitable, rectangles, traded on breakouts, key reversal days, better if at a third peak valley.
Right, the context matters for key reversals.
3 rising valleys falling peaks, stable trend following, and triangles, especially symmetrical. For triangles, it notes false breakouts are common, upward breaks slightly more frequent, and profit target often double the triangle height.
Good summary. And again, it refers to Bulkowski's empirical research, even providing a scoreboard table.
It points out you need patience for these patterns to develop, but need to act fast on breakouts. Experience is crucial.
Definitely takes practice. Finally, in Chapter 4, we get to PHI channel applications. The book explains investor behavior creates peaks, valleys, and PHI channels based on Fibonacci ratios act as trend indicators showing potential support resistance.
Okay, so channels based on PHI. Not immediate forecasts, but important levels.
Exactly. They help identify areas where buying or selling pressure might emerge. One limitation mentioned is that projecting these PHI ratios too far ahead can make the lines too wide to be useful, so it's better to work with recent significant peaks valleys.
Stick to recent action.
The book gives an S&P 500 example of looking for entries on breaks of these PHI channel lines. It summarizes this section as mainly educational, using 2001-2002 S&P data. Results look encouraging, but readers can fine-tune.
Okay.
It notes triggered lines indicate current market action, not future prediction, but the S&P example suggests long-term relevance.
Got it. Chapter 5 then shifts focus to basic features and parameters of PHI ellipses. Starts by reviewing exit rules for positions.
Right. Things like using a conservative trailing stop, like the 4-day high-low, though you risk giving back profits.
Yeah, the trade-off.
Using fixed profit targets based on Fibonacci percentages of the PHI ellipse height, 38.2%, 50%, 61.8%.
Okay.
Time-based exits, like 21 days if in profit, seen a three-wave move, still inside the ellipse.
Specific conditions there.
And finally, just exiting at the end of a newly formed PHI ellipse. This requires the most patience, but has the biggest potential gain.
Different strokes for different folks. The chapter then walks through working with PHI ellipses on daily data, using Japanese yen as an example over a year, explains the basic structure boundaries touch at least 4 key points: start, left, right, bottom.
Anchor points.
It details generating several ellipses, PHI-01, PHI-RU4, to illustrate trading decisions. Then takes an in-depth look at PHI-05, April NOF 2000, shows a strong up wave, AB, correction BC, third wave, CD, then reversal at D.
Right.
The book outlines 2 possible buy signals there. 1, breakout of 4-day high, point F, with fib targets based on AD plus trailing stop. 2, wait for PHI-06 formation, then look for a short entry on a 4-day low break. After leaving PHI-06, stop at highest high inside. Same targets, trailing stop.
Interesting options. Investor risk preference dictates the choice, as the book says.
Yeah. It briefly discusses PHI-07 for a broader view, noting reversals often happen at the final point of larger ellipses. And PHI-08 shows reversing to long after a short based on PHI-0607 got stopped out.
Includes a table summarizing trades from PHI-01 to 8 with different rules and outcomes.
Right. The book points out sharp V-turns after entry are rare. Usually more gradual peaks valleys form, helping reduce stop-loss risk. Suggests the approach catches major trends. Mentions preference for cash currencies. 24-hour trading, no gaps.
And stresses the importance of long-term historical testing for PHI ellipse quality. Highlights a WIN PHI software feature for constant price scale to avoid distorting ellipse angles.
Crucial detail. The book then continues with PHI ellipses on constant scales in the Japanese yen cash currency, analyzing over 2 years, SEP 98-2000 with backtesting.
Yeah, it suggests appropriately drawn ellipses at key turning points align well with price action, mostly.
It also briefly touches on profit target rules, using PHI ellipses, like closing near end of day, or when profit equals the height of the generating ellipse.
The chapter concludes by reconsidering the reliability of PHI ellipses, contrasting them with Elliott's more subjective wave counts. Acknowledges Elliott's foundation, but believes pattern recognition can be enhanced with computers and experience.
Okay. Chapter 6 then gets to the crucial part, combining Fibonacci trading tools. Points out you need to identify significant swing high slows and apply fib ratios, but acknowledges the challenge, consistently choosing the correct swings.
Yeah, that's subjective sometimes. Weekly data might not have enough swings. Daily has more, but maybe too many signals. Intraday, even more.
Right. The book argues combining Fibonacci with candlesticks and 3-point patterns is key to increasing profitable trades if applied correctly. Requires patience, discipline, and ideally their WN-PHI software.
The synergy again. The chapter specifically examines Fibonacci price correction levels, highlighting the difficulty. Stay close to fast moves, but wait for confirmation.
The timing challenge.
Exactly. Suggests adding candlesticks positively impacts performance. Looks at adding 3-point patterns to 61.8% corrections on the S&P 500. Shows examples where signals might fail due to other patterns, double, triple bottom stops.
Okay, so patterns can conflict.
But also shows the positive impact of using 3-point patterns with a backward look entry rule when trading 61.8% corrections. Suggests 3-point patterns are stable for monitoring investor behavior, though optimal swing size or entry rules might vary.
Need to take every signal, as you don't know the future.
Right. Emphasizes swing size, with 61.8% retracement, is crucial, determined by historical testing. Knowing the precise price level might be less important than the right swing size for that asset's volatility. S&P versus Microsoft versus Alliance examples.
Smaller swing, more trades. Too large, no trades. Best swing size often related to longest-lasting sideways patterns in history.
That's the suggestion. Also notes long-term Fib targets, 1.618x, 61.8% core, are harder to reach. Gives a long-term S&P wave calculation example, target 966.00, mentions looking at 50%, 61.8% correction levels if prices keep rising, and new extension levels possibly forming.
Okay. Concludes combining short long-term fib with extensions, three-point patterns, PHI ellipses is rare but powerful, requires discipline. Inexperienced traders might fear counter-trend signals, hence need multiple confirmations.
Makes sense. Next, Fibonacci price extensions revisited in Chapter 6. Reminds us they're typically defined on a three-wave pattern. Target initial swing 1.618 or other ratios plus swing end.
Right. But the focus here shifts slightly.
Yeah, shifts to thinking about these extension levels not just for counter-trend trades, but as significant indicators of potential major trend changes.
Ah, okay. Provides an S&P extension levels example. Jewel 01, November 2. Shows one swing, BC, as a correction of an earlier downtrend, then plots fib correction levels based on another swing, AB.
Suggests expecting resistance at these calculated price bands, but admits you don't know how strong it will be. Re-emphasizes fib extensions corrections point to price reversals, not timing. Shares that true story S&P example, target 750-800, reached after an unexpected up move, highlighting the timing challenge.
Price often right, timing tough.
Exactly. Mentions long-term trend changes in Japanese yen. Discusses significance of price bands clusters where multiple fib levels from different swings overlap. Suggests these are important for future projections, S&P, yen examples.
Okay, clusters are key areas. The book then moves to support and resistance lines, mentioning 5 specific price target clusters for the S&P 500 from FigCalc.
Right. Acknowledges no guarantee they'll be reached, but if they are, market might struggle to move through without a correction. Mentions short-term DAX 30 tests, suggesting a potential of SR based on recent peaks valleys on any volatile trending product, even without optimization.
Interesting. Provides an IBM trade example using resistance from a rectangle pattern, double width, as profit target. Focus on safe entry, high prob target. Rectangle, a common three-point pattern.
Another example, Deutsche Telekom, breakout from descending triangle, resistance line as target. Intel, descending triangle and rectangle breaks give buy signals, upper rectangle resistance as target. Mentions alternative long-term trailing stop strategy.
Lots of examples. DAX 30 index example shows short entry at rectangle resistance, then 2 long options after target hit, breakout of previous high, or breakout of rectangle resistance with new higher targets based on 3 valleys. Highlights price cluster, resistance line plus fib target.
Concludes by introducing dynamic adjustment of SR to swing sizes for entry-exit signals. Reiterates 2 ways to use profit targets. 1, breakout of trading range, rectangle, target double height. 2, breakout of trend line, triangle, target opposite trend line.
Okay. PHI ellipses, revisited in Chapter 6, describes them as proprietary transformation of ellipse formula using fib ratios, dynamically adjust to price moves based on peaks valleys, reviews basic structure from Chapter 5.
Then provides S&P short and long trade examples based on PHI ellipses. Short, ellipse from 4 points, sell on lowest valley break, target double width, stop at peak before. Long, ellipse from point 0, 1 valley, 2 peak, buy on final point breakout, stop at valley before.
Japanese yen example. Buy signal from symmetrical triangle, wave 3 start. Sell signal at PHI ellipse final point, resistance. Another symmetrical triangle forms. Sell on support ellipse break. Target 50% of swing 03. Stop at peak before.
Deutsche Telekom example. Long entry, EL4, based on perfect PHI ellipse, B, Danda, coincides with double bottom at D, head of inverted H&S. Buy on breakout of ellipse peak, target parallel resistance, stop at recent valley. Highlights counter-trend PHI ellipse signals worked perfectly here.
Wow. Suggests analyzing entries at final points in main trend direction, too. Another Deutsche Telekom example shows 5 trades, 4 short, 1 long, based on PHI ellipses using various peak valley touches. Targets calculated by doubling ellipse width.
Right. Chapter 6 then concludes with some final remarks. Authors reiterate goal: easy, reliable tools for improved absolute return. Touch on idea individuals might outperform experts sometimes. Lay out absolute return strategy basics. Systematic tested approach. 5-10 diversified products, less for intraday. Long short allowed. Stop target trailing stop on every position.
Hope the book helps readers find preferred strategies. Points out vast info available. This book selected tools profitable alone, even more so combined. Correct combo improves success in different markets.
But emphasizes good approach needs good execution. Circles back to trading psychology principles. Ego, hoping, losses, doubling down, pain level, diversification, hard work, plan, discipline.
Revisits magic figure 3, fib, candles, patterns, as common thread. Belief in pattern recognition. Correct execution and stop-start bits are key. Highlights WI and PHI software helps pattern recognition.
Then a tutorial section mention says examples show reliability consistency, introduces website www.fibotrader.com with membership for tutorials, WI and PHI info, market letters, model portfolios, aiming for a trader hub.
Includes brief list of abbreviations, section on winning POI software information, disclaimers, system recs, chart resolution, summary of user manual WinPio in PHI getting started. Install basic ops, specific fib tools in software, mention speed buttons, data loading limits.
Covered all the bases.
So to wrap things up, this deep dive into candlesticks, Fibonacci, and chart pattern trading tools has shown us a strategy that's really all about bringing together these three pretty powerful ways of looking at the market. The main ideas seem to be about understanding what drives investor behavior, using systematic rules for when to get in and out, and learning to recognize the patterns that emerge from how the market behaves.
Exactly. For you, the learner, we hope this has given you a valuable shortcut to understanding these, well, pretty sophisticated trading techniques by getting a sense of the logic behind them and seeing how they can be used in practice.
Yeah.
You should now have a more informed perspective on analyzing the market, and hopefully you've had a few of those aha moments as you've listened along.
Definitely. Think about how these principles, combining different analysis methods, really sticking to a disciplined, systematic approach, might fit into your own interests in the market. Maybe even go back and look at the original material with this new understanding to dig even deeper.
Good idea. And maybe to leave you with something to think about.
Mm-hmm.
In this ongoing dance between the emotions of traders, the mathematical beauty of Fibonacci, and the recurring patterns of market behavior, how do these forces constantly interact to create both opportunities and challenges for anyone involved in the markets? It's really a journey of continuous learning in a market that's always evolving.